Everybody. Well, we are checking in on markets, and I'm almost blending into the wall behind me because there is so much red on the board today in Europe. The stock 600 is down about 0.8%. But of course, the major focus for investors yesterday was that CPI print out of the US coming in slightly lower than expectations. And this is really crystallizing the case for a soft landing in the US. And people are beginning to dial down their expectations of further interest rate hikes. All that, of course, being quite positive for momentum. But the handover from Asia was quite weak. A lot of focus still on some of the weakness out of the Chinese data that has come out this week, as well as the property issues for the real estate sector. So coming into Europe, the handover was not so pretty. And you can see the stock 600 is down about 0.8% as well. It has been quite a roller coaster week for the stock 600 as we've gone through more and more of the earnings season. But in terms of the individual bourses, this is the picture today. All of them are down almost 1%. The Bercetche DAX down about 0.7%, even though the banks are having a relatively better day today. Remember, we started off the week talking about this arbitrary Italian banking tax that was imposed by the government that had quite an adverse reaction on some of the European banking stocks. They are beginning to gain ground again. The FTSE MIB itself is down 0.8%, similar to other indices. The CAC 40 down 1%. Luxury continues to be in focus there. Some deals going through in the US time yesterday. Tapestry, Michael Kors. So will that have a knock-on effect on European brands? Well, yesterday the reaction was quite positive. And over here in the UK, we're down about 1%. A lot of focus on the macro data. That UK GDP number coming in better than expectations. We're going to unpack that more on the show in a little bit. In terms of sectors, this is leadership today. Telco is the only slightly bit of green, but barely so. We're barely above the flat line. On the flip side, travel and leisure continues to underperform. We're down 1.3%. And remember, as oil prices start ticking higher, that's going to impact the travel and leisure sector. Real estate also a little bit lower today, down 1.3%. We are seeing an upward move in yield, so it tends to be inversely correlated. And then basic resources, the miners coming off a little bit in today's session as well. But the main story that we've been following overnight is news of UBS. So the bank has voluntarily removed the loss protection agreement it had with the Swiss government and Swiss National Bank, confirming that taxpayers will no longer bear any risks from the collapse of Credit Suisse. In an internal memo seen by Reuters, UBS says it is confident it will be able to bear the costs and financial impact of Credit Suisse's integration on its own. It added it has repaid, quote, all extraordinary liquidity support created by the emergency law. The 9 billion Swiss franc backstop was agreed as part of the lender's emergency takeover of Credit Suisse earlier this year, and the reaction, of course, has been quite positive. UBS trading up at around 20 Swiss francs. Now, additionally, UBS said it continues to focus on the successful integration of Credit Suisse, adding it still has a lot of work to do to reach the full potential value of the acquisition. The Swiss lender added it will provide more information on the process as part of its second quarter earnings out later this month on August the 31st. I'll be there myself. Now, former UBS UK Group CEO Mark Yellop told CNBC this morning that removing the backstop was inevitable and makes sense from a strategic point of view.
The risk